taxation of employment income. It's important to distinguish between a contract of service and a contract for service. Now, under this topic, because we are talking about employment income, employment constitutes a contract of service as opposed to a contract for service, which is a business contract. So you must first identify whether the person is an employee or the person is rather engaged in business. And I'm saying that there is said to be an employment contract if there is a contract of service as opposed to a contract for service, which is a business contract. Now, contract of service. It is sometimes necessary to find out whether an activity carried out by an individual amount to a profession or employment. From taxation point of view, there is the existence of employment when there is a contract of service, which establishes a legal relationship of a master and a servant. Such a contract may be written or unwritten. Where a contract is one of service depends on the facts of the case. For you to determine whether it's a contract of service or not, you have to look at the facts of the case. There are several considerations which may be relevant. But as a rule, it may be taken that a contract which gives one party, the employer, the power of controlling the acts of the other party, the employee, to the extent of directing not only the work which is to be done, is with contract of service. So what am I doing? I'm trying to come out with the distinction between what? Contract of service as opposed to what? Contract for service. Now, contract for service. A contract of service needs to be distinguished from a contract for service. The latter, that is the contract for service, give rise to a principal and agent word relationship. The latter give rise to what? Master-servant relationship. The employee is the servant. The employee is the master. Employer is the master. But for contract for service, it gives rise to what? A principal and an agent relationship. In this relationship, the principal engages the agent for these services, but does not direct how the services must be performed. So from this analogy, we can come out with these various differences between contract of service and contract for service. So if you want to establish what makes a contract an employment contract, then when you see all these features, then you will see that this is an employment contract. The one under the contract of service. Now let's look at the control. Under contract of service, the servant is controlled by the master in the manner of work. But under contract for service, there is no control. The principal does not control the agent. Delegation of powers. Delegation of powers is restricted when it comes to employment contracts. If your employer has given you something to do, though in some cases, especially supervisors, they can delegate, but there is always restriction as to the extent of delegation. But under contract for service, the agent is free to delegate the job to somebody else to do. What's important is that the job has been done. Profit and loss. Employees do not bear losses and did not keep profits. But under contract for service, the agent bears all the losses and keeps all the profits. Terms of service. Under contract of service, parties normally agree on employment contracts. But under contract for service, the self-employed, they determine the terms of the contract. How much will charge you and all that. They determine the terms. Logistics. Person for whom work is done provide logistics or tools for the job. Your employer will always provide you, the employee, with the tools. But here, persons for whom job is awarded provide for the job own logistics or tools. Time. Under contract of service, there is always a regular and defined hours of work. But under contract for service, the agent is free to decide when to work. What's important is the work has been done according to schedule. Holding of payment. Employers has no ability to withhold the payment to the employee. If he has earned the thing, why do you hold it? You cannot say you don't pay the salary. Even when the person is not performing, you pay. But under contract for service, ability to withhold payment or the service until work is performed as agreed. Lastly, dismissal. The employer has a dismissal power. But under contract for service, the principal has no dismissal power to dismiss the agent. No. The only thing is that work can be cancelled with compensation rights. So these are some of the distinguishing features between a contract of service, which is an employment contract, whether written or unwritten, and then a contract for service. Now let's look at some questions under this. Mr. Fortunatusman was engaged by Hipline FM 78.1 Accra to design and present programs on rural development on radio twice a week. Mr. Mann had worked in a South African state on such programs before. He and the FM station agreed on an amount of what? 2,500 for 8 programs a month. There was no time limit to the deal, but either side could terminate the contract with 1 month notice. He was provided with an office which he could use if he wanted. He would also have the services of a typist if he found this necessary. He was required to attend monthly staff meetings for review of the programs. Otherwise, he is free to do his work as he deemed fit. Even though he presented the programs regularly, he did not use the office facilities required. Determine whether he is an employee or a self-employed of the FM station. Bring out the necessary ingredients to substantiate your view. Now, like I said, if you're not too sure whether he is an employee or self-employed, don't go saying it. Okay? Come out with your analysis and then before you draw your conclusion. But if you are sure, why not? Like I'm sure that he is a self-employed, not an employee. For the following reasons. The reason is because he was provided with an office which he could use, which means that it was not by force for him to use the office. If it were to be an employment contract, if you are provided with an office, you cannot say you will not use it. But here, there was no compulsion on him to use the office. He also had the service of a typist if he found this necessary, which meant that there was again no compulsion on him. Though he was required to attend monthly staff meetings to review the programs, he was free to do his work as he deemed fit. Under employment contract, you are not free to do your work as you deem fit. No. Because it's a work that has been delegated to you, and delegation is restricted. So this guy, he can delegate this job to somebody else to do once he deems it fit. Even though he presented the programs regularly, he did not use the office what? Facilities. So that should tell you that that compulsion that the employer had to provide you tools to do the work. He was providing his own tools by way of even the office space, using his own office space or environment to do the work. So if you look at the ingredients in this particular case, if you're not careful, you may think that the person is an employee. No. The person is rather what? A self-employed. Illustration 1.2, all these are past questions actually. This was a letter to George. The address, Skyrock Ventures Limited, PO Box 021, Osu Accra, September 2017. Dear George, thank you for coming to see me yesterday. In response to our advertisement in the Daily Graphic, since our legal advisor resigned in July, a great deal of work has piled up, and we are anxious to get this cleared as soon as possible. You have indicated during our discussions that you have been dealing with such commercial cases for some time, and we are happy to engage you as a legal advisor. Our secretary will make available a room and all necessary documents to enable you to acquaint yourself with outstanding cases. Our offices are open from 8 a.m. to 5 p.m. and you can use our facilities during these hours. Your level of fees is acceptable, and we hope you can start work on Monday, 1st October 2017. I look forward to seeing you then. Yours faithfully, Joe Ansan, Managing Director. Discuss whether the conditions in this letter indicate a contract of service or a contract for service. 15 months. Now, the conditions in this letter indicate a contract for service, which means it is not an employment contract, but rather it's a business contract. The guy is a self-employed, George, for the following reasons. Now, one of the reasons you can adduce to this is that our secretary will make available a room and all necessary documents to enable you to acquaint yourself with our study cases. It does not mean that he is supposed to use the office space, because to get access to the cases, he must come at 8, between 8 to 5. And that does not necessarily mean I should come during those hours. Because the question says that, and you can use our facilities during these hours. So the fact that the office space was made available, there was no compulsion on him to use those office spaces. Then number two, the fact that the office opens from 8 a.m. to 5 p.m. does not mean that he was supposed to come to work at 8 and close at 5. The reason why they mentioned that was that if he wants to come and acquaint himself with the cases, it will only be done during office hours. So he can come between any time from 8 or 5 just to acquaint himself with the cases. Another point is that he has the upper hand in determining the terms of the contract, because they said your level of fees is acceptable, which means that he had the upper hand and determined the terms of the contract, and the company agreed with the fee that he is supposed to pay. And remember, employees don't charge fees, they are paid salaries. So that should tell you that this guy is not an employee. Now, the employer is also not going to direct him as to how he will go about handling the cases. So he is not controlled in the manner of work. So the marking scheme require that if you are able to identify writing that is a contract for service as opposed to contract of service, because there is an agent and a principal relationship as opposed to master servant, you get 3 marks for that. And then if you are able to give 4 points to buttress your point from the case, you get additional 12, making it what? 15. That's how they mark it. The last case under this issue. Rob Roy, May 20, 2006. Rob Roy is engaged as a disc jockey at a popular nightclub in Accra. Remember, examiners are tricky. So when you see some words, don't be carried away with those words. Analyze them before you start working your questions. Very important. His salary is based on 20% of gate proceeds when he is performing. He is paid on a monthly basis and is allowed to verify the gate proceeds. Is he an employee or a self-employed person? Rob Roy is a self-employed and not an employee for the following reasons. Number one, he is not on fixed salary. He is on fluctuating salary. Why? Because employees enjoy fixed salaries. Why are we saying he's on a fluctuating salary? Because his salary is based on what? 20% of the gate proceeds. Only when he is performing. Which means that if he is not performing, you don't earn anything. And even if he is performing at all, until a lot of gate proceeds come, before you also get more salary. If there are less gate proceeds, there will be less salary for him. Besides, he is allowed to verify the gate proceeds, which means that he actually determines the terms of the contract, because without that, no employee can be allowed to just go and verify gate proceeds because they want to use that so that you'll be sure of your salary. No, you are on a fixed salary. So whether there are gate proceeds more or not, you will pay the same fixed salary. These are the points you can use to buttress the fact that Rob Roy is a self-employed as opposed to what? An employee. Which means that all the 3 past questions, they were all on what? Self-employed or contract for service. Okay, now we come to the topic itself, taxation of employment income. Now, section 4, like I told you, section 4 is employment income, section 5 is business income, and section 6 is investment income. And I told you that for business income, we have done that already. And now we are coming to do what? Employment income. Okay? Which is one of the incomes which are semi-tax in Ghana. And this relates to employees' contract of service. So what constitutes an employment income? The income of an individual from an employment for a year of assessment is the gains and the profit of that individual from employment for that year or part of the year. So you see that in all the cases, it is what? It is the gain or profit from that particular thing. Now, anybody who is ascertaining the profit or the gains of that individual from employment shall include in the calculation the following. Number 1, salaries, wages, leave pay, fees, commissions, and gratuities. So if you are working on an employment income question, and there is salary, please make sure you add it. There is wages, make sure you add. There is leave pay. You know that some organization, when you go on leave, they pay you. You have to add it. Some people pay you commissions and fees. Please add it. Gratuity, end of service benefits and all that, you have to add it to the person's income and tax. You must also include overtime pay, it's an employment income. Bonuses are also employment income. So you add it to the person's income and tax. We will look at how these things are done. Personal allowances, including cost of living allowance, subsistence, rent allowance, entertainment allowance, travel allowance, etc. Or anything at all with an allowance, please add it to the person's income and tax. Cost of living allowance, risk allowance, responsibility allowance, dog allowance, house help allowance, security allowance, maid allowance, etc., etc., etc. Leave allowance, rent allowance, everything with allowance. Please add it and tax. But if they say accountable entertainment allowance, that one don't add. Or accountable interest, don't add. Because for that one, you are going to account for it. Number 4, a discharge or a reimbursement of an expense incurred by an individual or an associate of what? Of the individual. Okay? If there's any discharge or a reimbursement of any expense which has been incurred by the individual, and the company is the one who is paying your expense on your behalf, or reimbursing you for your own expenses, it becomes an income to you, and for that matter, it must be added to your income and what? Tax. Number 5, a payment made for the individual's agreement to any conditions of what? Employment. You know, there are a lot of fringe benefits when you are depending upon the conditions in your employment contract. All those things must be added to your income and tax. Then a retirement to contribution funds must be added to your income and tax. For example, any payment made by the employer towards any retirement fund must be added to your income and tax. For example, employer pay your SNIT, employer pay your provident fund, employer pay your tier 3 and all that. Please, all the employer's contribution towards the retirement fund is on section 94 of the Act. It must be added to your income and tax, please. And then other payments, including gifts received in respect of the employment. If by virtue of your employment you are receiving a gift, that should be added to your income and then what? And then tax. Okay? If the gift that you have received is by virtue of your employment, the gift must be added to your income and tax. Very, very important. Okay? Some people buy your schedule. You get some tips. Let's say a policeman buy the schedule. You get some tips by the roadside. He's supposed to add it to his income and what? And tax. And then any other amount that is supposed to be included, you have to include it. Now note, any other allowances or benefits which are paid to you in cash or given to you in kind, if they are derived by the individual during the year of employment, must be added to your income and tax. So remember, some of these benefits are by way of cash, some too are by way of kind. We'll look at that in our format. And you add it to the person's income and taxes. So including the calculation, all these. But exclude from the calculation any amount which is exempt under section 7, like I told you. So for example, if it were to be the president, then the salary, the allowances, the gratuity, the facilities of the president will not be taxed. Okay? So, and those foreign guys that we mentioned, those in the diplomatic missions and all that. So, once the amount is supposed not to be taxed, you also don't tax it. Now, if the amount is set to a final withholding tax, you have to tax it separately. You tax it to us separately. Okay? Remember, these are all tax planning weapons. When they say exclude something, okay, then you know how to talk about it to be a benefit to you by way of tax planning. So, number 3, a discharge or a reimbursement of expense incurred by the individual on behalf of the employer. If I'm an employee and I'm incurring expenses on behalf of the employer, why should I add it to my income and tax if the expense is to serve the proper business purpose of the employer? That one, you cannot add it to my income and tax. Okay? Your employer sent you and the TNT, then you add it to be my income and tax. No, it is to serve the proper business purpose of the employer. So any discharge or expense incurred by the individual, but it is on behalf of the employer to serve the proper business purpose of the employer. That way you don't add it to me, my income and tax me. Number 4, a discharge or a reimbursement of the dental, medical, or health insurance expenses of an individual where the benefit is available to each full-time employees on equal terms. So this one, they are saying that this is not our medical allowance. So if it's medical allowance, you add it to the person's income and tax, because whether he is sick or not, you'll be given that allowance. But this is where, by falling sick, you have to visit the hospital, and your employer is paying your medical bills for you, or the dentist, or if it's by way of a health insurance scheme that you are operating, and they are paying the premiums. That one, they say that one should be exempt. Though it's a gain from employment, it should be exempt. Okay? So please, in learning, it's very important to learn what should not be included, so that when you see it in the question, you don't include it. That makes employment income very simple. Then number 5, a payment providing passage of the individual to or from the country in respect of the employment of that individual by the employer, or the termination of the employment where the individual is recruited or engaged outside the country, is in the country solely for the purpose of serving the employer, and is not a resident of Ghana. So here what they are saying is that if I'm a non-resident, but I've been employed by an organization, and being a non-resident, it will mean that I was not in the country at the time I'm being recruited. So I have to now pack my things from that country and come to Ghana and come and work. Because I'm a non-resident, and my coming is towards the appointment in Ghana, and I'll be here solely to serve the employer and not to engage in any other employment, then any passage to the country, be it the air ticket, the luggages that you bring that the employer will pay on your behalf, though it's a gain from employment, it should not be taxed. Once it is to assume employment in Ghana. But remember, the person must be engaged outside where? The country. That's why the person must be a non-resident. So this applies to a non-resident who are engaged outside the country and is in the country for the purpose of serving the employer, and not to engage in any other employment. Now the same applies to the termination of your employment, and they are paying for the passage back to the country that you came from. That will also not be taxed. Okay? So it is for termination and what? It is for appointment and termination. I'm talking about the passage. Any passage, any payment providing passage. And I'm talking about the air ticket, the luggages and things that they will pay on your behalf to come and assume your appointment, or in respect of your termination. If it is not for assumption of your appointment and termination of the appointment, please, that one, make sure you tax it. Okay? Take note of that. Then a provision of accommodation by the employer carry on a timber, mining, building or construction, farming business or petroleum operations to the person at a place or site where the field operation of the business is carried on, or as prescribed by the regulation, is also exempt. This, we call it accommodation benefit. If you are an employee and you are working with a timber firm, a mining firm, a building firm, or a construction firm, a farming business, or you are with a petroleum operation, that's an upstream petroleum operation, okay? And you are being hired at the site or the field where the operation of the business is being carried on, though it is the employer who is providing accommodation for you, which would have been a benefit in kind, which would have added, because it is a timber. So here you have to number it: 1, 2, timber 1, mining 2, building 3, or construction, farming, petroleum. If you are working with any of these businesses and they are providing you with accommodation, and the accommodation must be at the site where the food operation is taking place, okay, then in that case, the accommodation benefit will be nil. So assuming I'm working a question and it's a mining question, and the guy is an employee in the mine, but the person is being housed at the mine site by the employer. If I say accommodation benefit, I'll say dash. Why? Because I'm falling on this particular provision of the law which says that it should be what? Exempt. Number 7. A payment made to employees on a non-discriminating basis, and which by reason of the size, type, and frequency of payments are unreasonable or administratively impracticable for the employer to account for or to allocate to an individual, that payment will be exempt. For example, you have a canteen and you all go there to eat rice or eat fufu. Administratively, it is impracticable to assign it to a particular person, so it will not be taxed. Or you have a welfare bus that carries you people to your workplaces, okay? Though you are getting a gain by way of traveling and transport, okay? Administratively, you cannot assign it to a particular person as to how much, okay? Therefore, it will be what? It will be exempt from tax. Then lastly, redundancy pay. If you are made redundant, especially as a result of amalgamation of the business, mergers, reorganization, or as a result of what? IT, information technology, sometimes can make people to be laid off, okay? Severance pay or redundancy pay is also exempt from taxation. An employee, we've explained all that already, okay? So, now, let me come to the general rule for taxation of income from employment. The general rule for taxation of income from employment is that the income shall be the individual's gain or profit from the employment. So find out whether it is the individual gain or profit from the employment. Then make sure you add it, unless it's supposed to be exempted. 2. The year of assessment for employment income shall be the calendar year, irrespective of the date in which the employment commences. So when you say the calendar year is the government fiscal year, which begins from January and ends in December. So in employment income, please, in writing your basis period, it must always be from January to December. And the year of assessment will be the year in which December ends in that year. So if, for example, the person was employed from August 2019 to the end of December, then the year of assessment will be the calendar year 2019. And the basis period will be from the time that the person was employed, 1st August 2019 to 31st December 2019. If the person has worked for the whole year, it will be January to what? December. So please, in employment contracts, your year of assessment should be the government fiscal year, the calendar year, 2019, 2018, 2016. And then your basis period should always end on 31st December of that year. Please, these are general rules which can help you in doing your computation. In instances where the employment commences on the days other than January, the year of assessment for many purposes will be period ending December for that year. The individual shall account for income tax on employment income on cash basis. And the tax payable calculated based on a 12-month period ending on what? 31st December each year, regardless of the period the employment is what? Exercise. So take note of that, that it should be December, please, I beg you. And then note, apart from mortgage interest, no expenses are allowed as a deduction under employment income. And then apart from contributions and donation to a worthwhile cause. Remember, in employment income, everything is done on cash basis. You are aware that your employer normally pays you. And by the time you go to your bank, everything is there. Okay? And then they are saying that when it comes to employment contract, one of the tax planning things for employees is the issue of mortgage interest, which was introduced into the Income Tax Act, where an employee has been given a mortgage and is paying the interest on that mortgage. Please note, so those of you who are not taking advantage of these things, you should go and take advantage of them. Okay? The mortgage interest is allowed as an expense against your income for them to determine your taxable income. Make sure you take out the mortgage interest. Charlie, this is a very big thing for you, pa. to reduce your taxable income. Okay, this is for a tax advice. Okay, and then if, for example, an employee contributes towards a welfare cause, when we're doing business income, we learn what are donations or contributions towards welfare causes. It can be towards sports promotion and development. It can be towards education or scholarships. Okay, it can be towards agric and all kinds of welfare causes, rural and urban development and all that. If an employee has made a contribution or a donation towards a welfare cause, that amount that the employee has contributed, these are all tax planning issues because it will reduce your tax liability. Take note. So please be very fast in things of this nature. Okay, so in that case, you will be allowed to deduct that contribution or donation against your income from employment so that you can pay a lesser tax. Now, taxation of benefits in kind. Where an employer makes payment for the personal needs of an employee through providing an employee with goods or services as opposed to money, these are called benefits in kind. Taxable benefits in kind typically include those benefits which are for the personal use or consumption needs of the employee. Example, employer providing housing for employee is a benefit in kind. Employer providing for education of the employee's children is a benefit in kind. Employer giving goods or services free at a cost lower than the market value. Employer providing domestic servants and security to employees. These are benefits in kind. Quantification of taxable benefits in kind. In general, the value of benefits in kind is quantified according to the market value of the benefit. That means the amount that an independent person would have paid in the market to receive the same good or service. So in trying to quantify benefits in kind, you must resort to the market value of the goods or service. Very, very important. Okay. In the absence of regulations, the market value less part of the cost of the benefit by the employee. Okay. In other words, the net realizable value. The net realizable value can be used. The net realizable value. Okay, that's the estimated market price of the goods less the cost of sale. Okay, especially if something has been, if the thing has been used for some time. Okay, then it will be the market value less the cost of sale. Now, one of the benefits in kind is what we call loan benefit. Another benefit in kind is called loan benefit. Okay, I'm taking you through all this so that when we start the calculation, you don't have any problem at all. Now, in the Income Tax Act, the issue of loan benefit came up. How do we do that? Where an employer gives an employee a loan at softer terms, okay? Basically, an employer is not responsible for provision of loans to his employees. However, as an incentive to the employees, employer may undertake the function of providing softer term loans to his employees compared to what a free market may offer. So the loan benefit will be that softer term loan that has been given to you, being the interest element. Remember, for the loan you are going to pay, so the loan is not the benefit. But the interest that you are supposed to be charged at a commercial rate, which they are charging you at a softer term, that is what we refer to as the loan benefit. Then we will now learn how to quantify it for the purpose of the calculation, or in terms of even theory as to how to calculate it. Where quantification is nil. There are instances where the employee may be enjoying a loan benefit. In other words, the interest lower than what the market is charging. Yet they will not quantify it for you to be added to your income and tax under benefits in kind. Under what circumstance can we say that even if there is a loan benefit, there will be no quantification for tax purposes? A benefit consisting of a loan provided for a year of assessment in return for services by way of employment is not quantified as under the following conditions. Number one, the loan must be from the employer to the employee. Number two, the term of the loan does not exceed 12 months. So if I'm giving a loan and the term of the loan does not exceed 12 months, I should be thinking of nil quantification. And number three, the aggregate amount of the loan and any similar loan outstanding at any time during the previous 12 months does not exceed 3 months of your basic salary. Under these conditions, there will be no quantification. And all these three conditions must be satisfied concurrently, that is, at the same time. If you satisfy one and leave the other, there will be quantification. So the three things are: the loan must be from the employer to the employee, the loan should not exceed 12 months, the amount of the loan together with any previous loan outstanding for the last 12 months, when you put it together, should not be more than 3 months of the employee's basic salary. If these three things are satisfied, we will say quantification is what? Will be nil. So if you are given a loan, a question, and in the question they say the employer is giving the person a loan, look out for the three things. If they are there concurrently, then please, there will be no quantification. But if the three things are not there concurrently, please make sure you quantify the loan benefits. We are coming to learn how to quantify it very soon. Okay? Now, in trying to quantify the loan, let me take you to the formula straight away. The formula is C is equal to B minus A divided by 4. The C there is the amount of loan quantified. That's the amount that you are going to bring into the calculation, into the benefits in under the benefit in kind and the loan benefits. In other words, the loan benefit, the figure you are going to write is the C. But how do you calculate that C? They say it's B minus A divided by 4. What is B? B is the interest payable at the statutory rate. Instead of using the commercial rate, they use the statutory rate. And the statutory rate is the Bank of Ghana policy, monetary policy rate, or sometimes they call it a prime rate. And it will be given to you in the exam room. A is the interest payable by the employee. And then when you get that, divide by 4. So let me give you an example. Let's say the employer has given you a loan of, I think we'll have some examples here. We have some examples here. A company has 3 employees. Okay? A company has had 3 employees during the 2016 year of assessment. And the following were their annual incomes: base salary, housing allowance, 10% of the base salary, transport allowance, employee allowance, total cash emolument. Besides the cash emolument stated above, the employees receive loans from the employer as follows. Kofi received a total loan of 8,000 at the rate of 8% payable within 12 months. Amma received a loan of 16,000 at the rate of 8% payable within 24 months. Kojo also received a total loan of 10,000 payable in 16 months. This loan is in addition to an outstanding similar loan of 5,000 during the previous 12 months. Required: determine the loan benefit applicable to the 3 employees, assume a statutory rate of 22%. Now, for you to know whether there will be quantification, number 1, the loan should, if the loan, for quantification to be nil, the loan must come from the employer to the employee. Number 2, the loan should be payable within a period of 12 months. And then number 3, the amount of the loan plus any similar loan as balance as standing for the last 12 months should not exceed 3 months of the basic salary. Let's go and do something and see. Kofi received a total loan of what? 8,000. Okay. Now let's go and see whether there will be quantification for. First of all, you need to determine whether there will be quantification before you do the calculation. So let's go and see. The loan is 8,000. Now, when is the loan payable? They say the loan is payable within 12 months. So one of the things that Kofi has satisfied is the fact that the loan is payable within 12 months. Okay. So he has certified that one. And number 2, the loan is also from the employer to Kofi. He has certified that one. That's number 2. Then number 3, the amount of the loan. Here we don't have any similar loan outstanding for the last 12 months. So the amount of the loan is 8,000. You have to go and calculate 3 months of the basic salary of Kofi to find out whether the loan has exceeded 3 months of the basic salary. If it has not exceeded, then there will be no quantification for Kofi. So then let's go and see the third one. So here I'll come and take Kofi's salary. We are looking for 3 months of the salary. Okay, so you find 3 over 12. 3 over 12 times 56,520. Okay, that's a big salary. And then when you do that, let's see, 3 over 12 of 50, 3 over 12, let's do the calculation quickly. 3 divided by 12 times 56,520. That's 14,130. And the loan is only 8,000. So it means that the loan has not exceeded 3 months of the basic salary of Kofi. Then you will see that in all the 3 cases, Kofi has satisfied the nil quantification. So in this case, when you are asked to determine the loan benefit applicable to Kofi, having come up with all this analogy, you will say that there will be no loan benefit to Kofi because quantification will be nil. Now let's do that of Amma. Amma also received a loan from the employer, so he has certified one. But the amount of the loan is payable beyond 12 months. Once you even establish this one alone, you don't need to know whether it is more than 3 months, is less than 3 months of the salary. No. Because once you miss one of the rules, there will be quantification. So therefore, for Amma, there will be quantification. But even, let me go and see 3 months of the base salary of Amma. Amma, 40,000. 3 divided by 12 times 40,000. 0.25 times 40,000. That's 2,500. Okay? But the loan of Amma is even more than 3 months of the base salary. So there will be quantification for Amma. If there will be quantification for Amma, how then do you calculate the quantification? Remember the statutory rate that was given in the question was 22%. So if you want to apply this formula, okay, then you find 22% of the loan that is being given to Amma minus the interest that Amma is paying on the loan itself. at the softer term, and you divide the result by 4, the answer is the loan quantified. That's all. So it's a very simple thing. So I hope you do that also for Kojo as well. And that's the calculations that are done here. Okay, very, very simple calculations. Okay, that's all. Now, let's discuss the issue of accommodation and vehicle benefits. This, we said, is also another benefit in kind. Under accommodation benefit, we have some people called direct service workers and indirect service workers. Where an employer employ the services of a cook or a maid servant, now they call them domestic servants or assistants, stewards. If your employer provides you with a maid or a cook or a steward, because they are serving you directly, we call them direct service workers. So if they are on the employer's payroll, the amount being paid to them will be added to your income and tax. So for direct service workers, the amount will be added to your income and tax. Now let's come to the indirect service workers. If the employer has given you an accommodation, but in addition has given you a watchman or a garden boy in that accommodation or apartment, for garden boy and watchman and security man for that matter, normally they are there looking after the property of the employer, not you directly. So we call them indirect service workers. So even if they are on the employer's payroll and they are paying them, that amount will not be added to your income and tax. So for direct service workers, on employer's payroll, the amount will be added to your income and tax. But for indirect service workers on employer's payroll, the amount will not be added to your income and tax. However, look at this. If the employee lives in his own apartment, his own accommodation, not the one provided by the employer, but the employer has employed the services of a watchman or a garden boy, remember the apartment is for the employee, not the employer. So even if they are there to look after the property, they are looking after the property of the employee. So it is the employee who is getting the gain directly. Therefore, in that situation, the watchman and the garden boy will become a direct service worker. Hence, any income being paid to them will be added to your income and tax. Take note of this analogy. So never say that watchman and garden boy is indirect, whilst maid and cook and stewards are direct. No. For maid, cook, and stewards, that one there is direct. But for watchman, garden boy, you need to look for whether the property is for the employer or it is for the employee. If the property is for the employer, that's where you don't add it to your income and assess. But if the property is for the employee himself, then any amount paid to them will be added to the employee's income and tax. But note, where the employer directly gives you, the employee, the money to go and rather pay the watchman or the garden boy, that one, it will be added under your cash benefit and tax. Because the cash was directly paid to you, the employee, to go and pay the watchman or the garden boy. Therefore, it becomes a kind of allowance to you. As to whether you even pay them the same amount is also another matter. So because of that, it will be added to your income under cash emolument and tax. So that is the principle there also. Now, let's come to how to compute accommodation and vehicle benefits. How to compute it. Because these are benefits in kind. So, in the question, they only tell you that he is giving accommodation, but they may not give you any figure. So this particular area table will show us how to compute it to add to the person's income and tax and a benefit in kind. We are starting with the accommodation benefit. Now, this is the the facility you have to look for in the question. Ask the particular question, what facility was given to the employee? Was the employee given accommodation with furnishing? If the employee is giving accommodation with furnishing, then you come here, you find 10% of the total cash emolument of the employee, and that will be the figure which will stand for the accommodation benefit. If the employee is given only accommodation without any furnishing, then you find 7.5% of the total cash emolument. This is true and poor, okay? Now, in some organizations, the employees will only be given furnishing. They are not given accommodation, but they are given furnishing, okay? Then that one will be 2.5% of the total cash emolument. In some cases, the accommodation will be a shared accommodation. The employee is sharing that accommodation with another employee. Then that one, if that's the case, it will be 2.5% of the total cash emolument. So that's how we calculate the accommodation benefit. Very, very simple. Okay. So these particular facilities, all of them will not be there at the same time. It will be one of these, and you have to determine which one and determine which particular percentage you are going to use. Okay, that's all. Now note, after you have calculated accommodation benefits using this, noting this, the particular facility, if in the question the employee, in some organizations, that accommodation will not be given entirely for free, but you will be made to pay part of the accommodation, then when you do the calculation, you have to less the amount paid by the employee before whatever is left, you extend it. If the calculated figure is perhaps 10,000, and the amount paid by the employee for that year is also 10,000, then you will say 10,000 less amount paid by employee 10,000, and the figure will be nil. Now, if the amount paid by the employee is 10,000, the calculation is 10,000, and the amount paid by the employee because of the luxurious nature of the accommodation is, let's say, 12,000. It means the amount paid by the employee is even greater than the calculated figure. But in extending the difference, you don't say negative 2,000. No, you still have to say dash. Under no circumstance should you make accommodation benefit negative so as to reduce the assessable income. I repeat, under no circumstance should you make accommodation benefit negative so as to reduce the assessable income. If the amount paid by the employee is more than the calculated figure, still stretch your figure to nil. The next benefit in kind calculation we want to look at is vehicle benefit. This facility comes in where the employer gives an official vehicle to the employee, which he uses for both official and for private purposes. It is the private factor that brings in the motor vehicle benefit. And again, you have to look out for what facility was given to the employee in the question. Was the employee given vehicle with fuel or fuel coupons? If the employee is giving vehicle with fuel and with fuel coupons, then it's going to be 10% of the total cash emolument. But note, unlike accommodation benefit, there is always a restriction or a ceiling to vehicle benefit for a particular facility. So if you calculate the vehicle with fuel 10% of the total cash emolument, and you had about 8,000 for the year, you have to compare it to the ceiling in the law. The ceiling for a vehicle with fuel or fuel coupons is 500 Ghana per month. And 500 Ghana per month times 12 is 6,000. So if the calculated figure is 8,000 and you compare it to the ceiling and it is greater, you have to restrict the answer to 6,000. And under no circumstance should the calculated figure be more than the ceiling or the maximum limit. I repeat, under no circumstance should the calculated figure, that's the 10% of the total cash emolument for that matter, be more than the maximum limit. If the calculated figure is more, first state it, shift it to even left side of the answer, and then rather extend the answer to the 500 times 12, which will be the restricted figure, and that will be the correct figure for the vehicle benefit. But you have to show both. But the other one, you just show it and underline it somewhere. They will mark that one also for you. You are telling the examiner that yes, you calculated and the figure was rather more. So you are limiting the answer to the ceiling, because under no circumstance should the amount calculated be more than the limit. If the employee is giving only vehicle without any fuel, then that one it will be half of this one. So 5% of the total cash emolument, and the restricted figure is 250 per month. Please learn it per month, because if the base one is 6 months, they say 250 times 6. You understand? Fuel only. In some organizations, the employee has the vehicle, but it's the employer that fuels it. Also 5% of the total cash emolument, restricted to 250 per month. In some cases, especially the mining directors, they are giving vehicle, fuel, and a driver. So we call it chauffeur-driven vehicle. Chauffeur-driven vehicle. In that case, it's going to be 12.5% of the total cash emolument, but the restricted figure is what? 600 per month. So this is how we calculate the vehicle benefit as well. Okay. Now, we told you that redundancy or loss or termination of your employment, and you are being paid in a lump sum, that one is exempt from what? From tax. Generally, payment on termination of employment or redundancy are not taxable because they are not in return for the services rendered. Lump sum payment and other payment made to employees on the termination of their contract of employment as a result of management decision, but not through their own volition, is exempt. However, a lump sum payment made may have attributes of taxable remuneration and tax-free compensation. A payment that relates to the employee's entitlement under his contract of service is taxable. A lump sum paid as a genuine compensation for loss of office will not be what? Will not be taxable. Example of payment that are taxable include payment in lieu of notice is taxable. Okay? If you want to leave an organization, if employer wants you to leave an organization and you did not give you sufficient notice, and because they have to pay you in lieu of notice, that one, it will be added to your income and tax. Payment in lieu of leave is also taxable. Okay, it's also taxable. Now, for medical and dental expenses, I've told you that provided it's available to all full-time employees on equal terms, it will not be taxed. And remember, it should be a discharge or a reimbursement of those medical or dental expenses. But the fact that they say it should be available to all full-time employees on equal terms doesn't mean that if a management staff is being paid, is going to a bigger hospital or a posh hospital, and then a junior staff is going to a lesser posh hospital, then there's discrimination. No, there's no discrimination. Monkeys live by their sizes. I told you that if by virtue of your employment you receive a gift, okay, that gift will be added to your employment income and tax. If the gift is in kind, not in cash, it will be on the kind side. But if the gift is in cash, it will be under the cash side of your solution. So examples are tips, awards, and all that. Okay, appreciations, on all that. Okay, Now, normally after you have arrived at your total accessible income, you have to less your tax reliefs from it. You have to less what? Your tax reliefs from it. So this portion of the lecture will tell us how to determine the various reliefs for tax purposes. I'll take you through the reliefs as at December 2019, and then I'll also mention to you what the new figures are from January 2020. Okay? But if the question is going to be up to December 2019, you don't use these ones. This one is effective January 2020. So you'll be falling on the old ones. And if you look at your questions, since you are in 2020, your questions may be up to 2019. Therefore, you'll be compelled to use these particular ones. But if by way of theory or anyhow, they decide to ask you of the new rates, then that one you have to use it beginning from January 2020. What are the various reliefs? But what is a relief in the first place? A tax relief is an approved deductible allowance, okay, from the assessable income of what? Of the employee. And it is given to mitigate his tax burden, okay? A tax relief is an approved deductible allowance from the assessable income of the employee or the individual, and it is given to cushion him or mitigate his what? His tax burden. Lastly, a tax relief is an approved deductible allowance from the assessable income of the individual. It's only individuals who enjoy tax reliefs. And is given to what? To mitigate his or her tax burden. The following are the various types of reliefs. Basic relief. A basic relief is normally embodied in the tax scale. The tax scale is what we call the graduated rates. In the graduated rates, the first chargeable income bracket, which the rate is free or 0%. That figure, which is denoted as free, is referred to as the basic relief. You see, you only enjoy it when you are computing the tax. So that one, we don't subtract it like the way we have been subtracting the other reliefs. But invariably, it is subtracted because before you determine the taxable income, that first income bracket is 0%. Hence, that will not be taxed. Hence, it is called basic relief. So it is normally embodied in the tax scale. As we are going to work a question, I'll show you what the basic relief is in the question. The second relief, dependent spouse / children relief. We used to call this marriage / responsibility relief, but now it is called dependent spouse / children relief. This relief is available to employees who are married. Once you are married, you have a spouse. It can be a husband, it can be a wife. So you qualify for the relief, and the figure is 200 Ghana for the whole year. That's up to December 2019. So if the question is 2019, and you are told that the person is married, please, 200 Ghana. Straight, you write it there, dependent spouse. But they have increased it to 1,200 since January 2020. It has increased what? 1,200. But note, this relief is also available to people who are not married but have 2 or more children who are depending on them. That's what I'm saying, dependent spouse / children relief. The question is, what are they depending on? They are depending on you for the basic necessities of life. That is food, clothing, and shelter. So the law says that in that case, then let's give you a relief of 200 Ghana. Then what if the person is married and has 2 or more children at the same time? Please don't double the figure. It's the same 200 Ghana. Okay. So please, this relief is not available to only married people. It's even available to who? Unmarried men or unmarried women. In other words, even if the person is a widower or a widow, but you have 2 or more children, if you have just 1 child, they will not give it to you. It must be 2 or more children. That's what they say, children. Okay? But assuming in the question, the person is married but has 1 child, oh, you get it. You are getting it because of the marriage. So that's all. The next one is child education. Child education relief. Child education relief. And it is to a maximum of what? 3 children attending approved secondary schools in Ghana. I say secondary school, sorry. Attending approved schools in Ghana. I repeat, the child education relief is available to employees who have children that they are put in school. They are looking after them in school. Not the basic necessities of life. No, the basic necessities of life is the dependent children relief. But the child education is for putting the children in school. And the school can either be a first cycle school, a second cycle school, or a third cycle school. Okay, provided the person is not employed and is attending school. No, if you have a child who is already employed and attending school, not that one. We are talking about those who are not in employment and they are attending schools. It can be university, it can be secondary school, or it can be basic school. And it is the limit is only to 3 of your children. So if you have about 8 of the children attending schools in Ghana, it should be in Ghana. Please, they will limit it to only 3 of them. Okay? And it is 200 Ghana cedis per annum per child. 300 Ghana cedis, 200 Ghana cedis, just like the marriage, per annum per child. But this has been increased to what? 600 Ghana cedis per annum per child in 2020. Old age relief. This relief is available to an employee who is 60 years and above, but still in employment. Okay? If you are 60 years and above and you are still in employment, you qualify. For example, the Article 71 service holders, you know they retire at the age of 70 years, like the Supreme Court judges, the EC chair, etc. They retire at the age of 70. So such people, they qualify for old age relief if they are 60 years and above. Please, below 60 years, you don't qualify. How much is the figure? 200 Ghana for the whole year. But it has been increased to what? 1,500 for the year. So it means that people should rather take advantage now because the figures are high. The next one is disability relief. An employee who is disabled or physically challenged, you qualify for this relief. Either you are blind, you are a cripple, your legs have been amputated, etc., etc. These are called disabled persons, but they prefer to call them physically challenged. It is the highest of all the reliefs. Why? Because it is 25%, that's 1/4 of your total accessible income from employment and business. You will find 1/4 of that. So it is not an absolute figure. No, it is a relative figure based on your total accessible income. But it should be from employment or business, but not from investment income. So if the guy is into employment and is into business at the same time, you add the 2 and find 25% of it. And that will be the relief for disability. So it's the same, it has not changed in 2020. Aged dependent relief. This relief is available to employees who take care of their aged relatives. If you are an employee and you have been taking care of your aged relatives, you qualify. But it is only to a maximum of 2 aged relatives. And the figure is how much? 100 Ghana. Only 100 Ghana for the whole year. Per aged what? Relatives, sorry. But this has been increased to 1,000 Ghana per annum in 2020. So you see, I'm very current. Now, professional stroke, technical, and note, if you are two brothers, remember, two brothers have the same uncle. So if one brother is taking it for one uncle, the same brother, another brother cannot take it for the same uncle. That second brother should also go and look for another uncle, so that he can also take it for that person, provided you are taking care of them in terms of their basic necessities of life. Professional, technical, and vocational training relief, excluding academic knowledge. If it is about university, please, that one you don't get it. But it is if you are pursuing a professional course or a technical program or a vocational program, not academic. If there's someone want to trick you, they will say that he is attending a master's program at UPSA. Please, you don't qualify. It should be a professional, a technical, or a vocational training. The relief is only 400 Ghana for the whole year. So most of you who are doing CA, you qualify for this relief. But it has been increased to 2,000 Ghana in 2020. But because your questions will be 2019, you learn the old one. The next sitting people, they are going to learn these new ones. Now, Social Security. You are aware that employers are supposed to contribute to the Social Security scheme as a compulsory thing on behalf of their employees. Employer contributes 13%, and you are aware that an employee is supposed to contribute 5.5%, bringing the total to what? 18.5 on their basic salary, unless otherwise stated in the question. It should be on the basic what? Salary and nothing else. So whenever you are calculating SSF or SNIT, it should be on the basic salary. So if you want to calculate the employee portion, you find 5.5 of the base salary, and that will be the relief. If you want to calculate the employer portion, it will be 13% on the base salary, and that will be the relief. Now note, if in the question you were told that the employer contributes to SNIT on your behalf, and I said all contributions by the employer towards your retirement benefit or fund, they add it to your income and tax and a cash benefit. Then it means that when you find 13% of the base salary and add it to the person's salary and tax, then when you are doing the relief, he will qualify for two, both the employee and the employer portion. But where the employer portion is not indicated at the top there, by way of adding to the person's income and tax, you don't come down and take the 13% on the base salary as a relief. No, it will only be the 5.5% of the basic salary. But for a self-employed person, since you are the employer at the same time, the whole of the 18.5% will be given to you as what? Will be added to your income and tax, and will be given to you as what? As a relief. Now note, I want to use the 18.5% to explain the three-tier scheme for you. Currently we have a three-tier scheme. Before that, normally the 18.5% being the 13% of the base salary contributed by the employer, and the 5.5% of the base salary contributed by the employee. I want to explain to you how this is what we use to pay tier 1 and tier 2. I want to explain to you how to break the 18.5% down for tier 1 and tier 2. But note that the 18.5%, 13% comes from the employer on your behalf, and 5.5 is from your own basic salary. They'll give it to SNIT. Now, out of the 18.5%, 2.5% is taken and given to the National Health Insurance Scheme towards the payment of your National Health Insurance premium. So you are left with what? 16%. So when they say explain the 3-tier scheme, which has been coming in part 2 students, when they say explain the 3-tier pension scheme, you see them explain tier 3. You are wrong. They say 3-tier pension scheme. So there is tier 1, tier 2, and then there's tier 3. So don't go talking about only tier 3 when they say 3-tier. Okay. So now you are left with 16%. Out of the 16%, 11% will be paid to SNIT towards the monthly pension of the employee. So when you go on pension, SNIT will pay you a monthly pension until you die. The remaining 5%, employers are supposed to appoint their own fund managers who will manage this 5% on their behalf. Okay? And that is the tier 2. So the tier 2 is towards the payment of a lump sum of 5% plus the return that will be generated on it. Note that the tier 1 and tier 2 are mandatory. They are mandatory. And they are regulated by the NPRA, the National Pension Regulatory Authority. They regulate the tier 1 and tier 2 and even the tier 3 as well. I'll come to the 3 right now. So that is how the 18.5% works. I think I've explained myself now. Then there is also the tier 3, which is the voluntary one. The employers are encouraged in order to increase the welfare of employees when they retire to contribute towards a tier 3 on their behalf, so that by the time they will retire, they will also get some return and some investment in this tier 3, which is a voluntary one. This one, if your employer hasn't got money, he will not do it for you. For this particular one, the employer can choose to contribute any amount on your behalf. It can be 5, 10, 8, depending on how wealthy the employer is. And then they also can tell you to top it up. Okay? So some organizations, the employer may contribute 5%, and they will tell the employee to top it up by 5. Some to employer contribute 10, and they will tell the employee to also put 5 there, so that in future, when you go on pension and they invest this amount, you enjoy it after your pension. And it's also a lump sum payment after your pension. Okay? It's a lump sum payment, but it's a voluntary one. You choose any fund manager and a trustee to manage it for you. Okay? Now, but to be an allowable tax deduction, the amount contributed by the employer and the employee should not be more than 16.5%. So if you have an organization where the employer is contributing 20% to tier 3 on your behalf, and you, the employee too, you are contributing 10%, making it 30. In calculating your tax liability, they will limit the relief to only 16.5%. That will be the relief you can enjoy, but the rest there, it will not be granted to you as a relief. So take note that it should not be more than what? 16.5% for both the employer and the employee contribution. It should not exceed 16.5% to enjoy the relief. Okay? And this amount, you cannot withdraw it till after 10 years. For the tier 3, you cannot withdraw. As for the tier 1 and 2, unless you go on retirement. But for tier 3, you can withdraw, but you cannot withdraw it unless after 10 years. If you withdraw it after 10 years, before 10 years, you pay a penalty of 15% on both the principal and the interest withdrawn. You pay a penalty of what? 15% on both the principal and the interest withdrawn. So that is all for you under the reliefs. Now, so far as all these reliefs are concerned, which of them do you call upfront reliefs? There are 5 of them. The upfront reliefs, okay? There are 5 of them. And these are reliefs which you can deduct upfront. Normally, reliefs can be enjoyed by filing your returns by the end of the year. The reason why most people don't enjoy some reliefs is because they don't file their returns at the end of the year. So most of us don't enjoy the reliefs. But there are some reliefs which is not tantamount to filing returns at the end of the year. You can even enjoy it during the year. One of them is Social Security. You are aware that you enjoy it. We don't file the returns, but you enjoy it. The tier 3 to the same thing. Then we also mention another relief that you can enjoy without filing returns is the basic relief, the one which is embodied in the tax scale. Okay, but they are not the upfront too. You enjoy it during the year, in the month that is done. SNIT is one, tier 3 is another one, and also basic relief. But among the other reliefs, for you to enjoy it, you must file returns by the end of the year. However, from 2001, there are some reliefs which you can still enjoy upfront without having to file returns at the end of the year. And those are the reliefs we call the upfront reliefs. But for you to enjoy it, this is what you have to do. Close to the end of every year, preferably October, November, and December, employers are required to visit their nearest domestic tax revenue division of the GRA, where they file their tax returns, to obtain a tax relief application form, IT-21, on behalf of their employees. Each employee is expected to fill the form, making sure that all information provided is complete and accurate. The employee then hands over the form to the employer, who will then vet it to ensure the information provided is accurate and complete. The employer then submits the form back to the Domestic Tax Revenue Division office for further processing. After approval by the Commissioner General, the form is translated into a tax relief card. The original of the card, that is DTII 111A, is kept by the Commissioner General, while the extract of the card DT111B is given to the employer on behalf of the employee. And once this is done, you can go ahead and enjoy these reliefs upfront. They are the dependent spouse / children, the old age, the child education, the disability, and then the aged dependent reliefs. These are the reliefs which are referred to as what? The upfront reliefs. But it is contingent upon the filling of the tax relief application form and upon the approval of the Commissioner General. Before come January of the ensuing year, you can start enjoying these reliefs. I'll crave your indulgence to engage the accountant of your organization to take advantage of this provision, so that those of you who are married and have dependent children, you are old, beyond 60, you are still working, you have children attending schools in Ghana, and you are disabled, or you look after some aged dependents, you can enjoy these reliefs afterwards. Okay. So for this one, I've explained already. Payment providing passage to an individual in respect of first employment and termination. This is the one that will not be added to your income and tax. Okay. Provision of accommodation on site. We've explained already. But note, if it is an administrative head office and you are giving, for example, you are working with Anglo Gold Ashanti, but you are being housed in the administrative, you are not at the site, that one, they will not mind you. They will not mind you, cry, they will not mind you. Then the payment made to employees on non-discriminatory basis. The examples that we were talking about. Number one, free or subsidized meals provided in a staff canteen by the employer, so long as the meals are available to staff generally and not provided as part of the salary sacrifice. Number two, mobile phone usage, where there are no land phones and is available to all employees. They are giving you examples of payment made to employees on a non-discriminative basis, the one that is not supposed to be taxed. Examples are free or subsidized meals provided in a staff canteen by the employer, so long as the meals are available to staff generally and are not provided as part of salary sacrifice. Two, mobile phone usage, where there are no land phones and it's available to all employees. Three, bus services provided by the employer. Four, annual staff parties and functions. Five, recreational and sport facilities available to all employees. Example, gym. Six, counseling services to redundant employees and welfare counseling services available to employees generally. Seven, health screening and medical checkups. Eight, provision of eye care tests and corrective glasses. Nine, provision of parking facilities for all what? Employees. All these will not be added to your income and taxed. Then the last explanation I'll be giving will be in respect of the tax rules regarding overtime and bonus. And then you can now work questions. Okay. Now, where an employer, so I'm starting with overtime. Where an employer makes an overtime payment to a qualifying junior employee, the employer shall compute taxes on overtime as follows. Where the overtime payment does not exceed 50% of the basic salary. Some people, when they are writing, they go and write 50% of accessible income. No, they say where the overtime does not exceed 50% of the basic salary of the employee for the month, the overtime payment shall be taxed at a rate of what? 5%. Where the overtime payments exceed 50% of the basic salary of the employee for the month, the overtime payment up to 50% of the base salary will be taxed at 5%. And the excess overtime payment beyond the 50% of the base salary for the month shall be taxed at what? At 10%. Both constitute a final withholding tax. Thus, for qualifying junior employees, none of the overtime will be added to the accessible income and tax using the graduated rate. All of the overtime will be taxed separately. So for qualifying junior employees, when it comes to taxation of overtime, please never add the overtime to the person's income and tax. Tax it separately. How do you tax it separately? Where the overtime does not exceed 50% of the basic salary, please compute 5% on the overtime figure separately. Then you are done. But where the overtime exceeds 50% of the basic salary of the employee, if you are a qualifying employee, a junior employee, in this case, there will be two computations. The first one is the portion of the overtime, which is up to 50% of the basic salary. You tax that portion at 5%. And then the one beyond the 50% will be taxed at what? At 10%. And the two all should be taxed separately because they all constitute final taxes. Now the question is, who then is a junior qualifying employee for whom we don't add overtime to their income and tax, but we tax separately? Note, if the employee is not a qualifying junior employee, when it comes to the taxation of the overtime, add all the overtime figure to the person's income or the cash benefit and tax using the graduated rate, which is normally under the first schedule of the Income Tax Act. The graduated rate is normally listed on the first schedule of the Income Tax Act. I repeat, where the employee is not a qualifying junior employee. So anytime you get a question on overtime, find out whether the person is a qualifying junior employee. Where the employee is not a qualifying junior employee, please, you don't tax separately 5% and 10% to no. The whole of the overtime will be added to the person's income and tax using the graduated rate. This is how we tax overtime. The question is, what's the definition of a qualifying junior employee? Two things must feature in that definition. If any one of them is missing, the person is not a qualifying junior employee. I repeat, for a person to qualify as a qualifying junior employee, two things are required. Number one, the person must first of all be a junior staff. And then number two, the junior staff's qualifying employment income. Here, to when students are writing, they say qualifying basic salary. No, your total qualifying employment income. The total qualifying employment income is your total income from employment, including the overtime figure. It should not be more than what? 18,000 cedis for the year. Or that's 1,800 currency points. A currency point is 1 Ghana cedi. Okay? So 1,500, it should not be more than 18,000 currency points. And the 18,000 currency point is 18,000 cedis because a currency point is 1 Ghana cedis. 1 Ghana cedi, sorry. Okay. And if you divide it by 12, it's 1,500 per month. So a qualifying junior employee, two things: a junior staff whose qualifying employment income should not be more than, in other words, it should be up to 1,500 per month or 18,000 cedis per year. If you don't have these two things, you are not a qualifying junior employee. And for that matter, if you are paid overtime, the whole of the overtime will be added to your income and tax. Note, where both conditions are not met at the same time in a month, overtime payment shall not be taxed at a concessionary rate or as a final tax, but rather the whole figure will be added to your income and tax. Taxation of bonus. Where an employer pays bonus and other bonuses within a year of assessment to an employee, this is how the bonus will be taxed. The bonus up to 15% of your annual basic salary. You know, bonus are normally paid at the end of the year. So bonus up to 50% of your annual basic salary, you shall tax that portion at 5%. Any portion of the bonus which is more than 15% of your annual basic salary, that excess bonus will be added to your income and tax the normal way. It will be under the cash benefit. So under the cash benefit, if the bonus amount is more than 15% of your annual basic salary, you will tax the portion of the bonus amount which is up to 15% of your annual basic salary. You tax that one at 5%, and it's a final tax, so it should be taxed separately. And then the difference, what is left, is called excess bonus, and that's the one that will be added to your income and taxed the normal way. That's all. And this is an example. Kofi Efia works annual salary was 100,000. She was paid a bonus of 14,000. Determine how the bonus will be taxed. What you have to do is that you first find 15% of this annual basic. 15% of this will give you about 15,000 cedis or so. And the bonus is only 14, which means the bonus is not more than 15% of your annual basic. Therefore, the whole of this bonus, 14,000, will be taxed at what? 5%. And 5% of 14,000 will give you 700 Ghana cedis or so. And that's the taxation of the bonus. Which means that none of the bonus will be added to his income and tax. Why? Because no portion of the bonus is more than 15% of the annual basic salary. Another one. Kwame Fiavi works with Lipawa Company Limited on an annual salary of what? 120,000 cedis. He was paid a bonus of 20,000. Determine how the bonus will be taxed. Again, the first thing to do is to find 15% of this 120,000. Okay? 10% we are giving you 12,000. So 15% will be half. It will be 18,000. Okay? 15% of 120,000 will give you 18,000. Meanwhile, the bonus was what? 20,000. Oh, then you tax the bonus up to 15% of the annual basic. That's the 18,000. You tax that one at 5% separately. But the remaining bonus, which will be 2,000, because you have taxed 18,000 at 5%. The remaining bonus, which is a 2,000, we will call excess bonus. And that one, it will be added to Kwame Fiavi's employment income and tax the normal way. It will be added under the cash benefit. So that's all. This is how we tax bonus. Now, how do we tax temporary staff? Please remember, in your exams, it can be theory or it can be calculation. So don't just focus your mind on theory. Some of these things can be asked just to explain the tax treatment, okay, of bonus, the tax treatment of overtime, and all that. So you are looking at the tax treatment of temporary staff. Where a person makes payment to a temporary workers, as defined under Section 78 of the Labour Act, that payment shall be treated as income earned by the temporary worker, and the person shall withhold tax from that income in accordance with Section 114 and the first schedule of the Income Tax Act as amended. That is what? Using the graduated rates. So in short, in taxing temporary staff, you tax them the same as permanent staff. That's all. That's what they are trying to say. The way we tax permanent staff using the graduated rates, that's the same way we tax temporary staff as defined under Section 78 of the Labour Act. How do you tax casual workers? Casual workers. Okay? The law says that when a person makes a payment to a casual worker, casual worker is not the same as temporary staff. Casual worker, today, no, you can even sack him. When they finish their work today, they are gone. Okay? Where a person makes payment to a casual worker, which payment shall be treated as income earned by the casual worker, the person shall withhold tax from the gross income paid to the casual worker at a rate of what? 5%. And the tax withheld shall be treated as what? A final tax. So for casual workers, whatever gross amount that was paid to them, you take 5% as a withholding tax and account for such an amount to the Commissioner General and give the 95% to the casual worker. That's how we tax casual workers. So these are some trial May 2018. Briefly discuss the taxation rules on the following: payment of overtime 2 marks, payment for bonus 2 marks, payment to casual workers 1 mark, payment to temporary staff 1 mark. In all, you get 6 marks, and then left with 44 to pass. Now, the next thing I would like to take you through is, in some questions, when we go by the format, we start with the salary of the employee. But in some questions, the employee will not be given the salary as stated in the question, but rather they will give you the salary scale of the employee. And they will tell you, and you have to use the salary scale to determine the salary for that particular year of what? Assessment. So we want to learn where you are not giving the annual salary for the year in question, but you are rather giving a salary scale. How do you use the scale to determine the salary for the year? Illustration. Kofi Azonto is the sales manager of Afoko Pioneers Company Limited, manufacturers of mango juice. He was employed on 1st July 2012 on a salary scale of 40,000 by 2,000 Ghana to 60,000 required. Determine his salary for the 2017 year of what? Assessment. So you have been given a salary scale effective from the date the person was employed. You are aware that when the employers, they quote our scale for us, starting from when we were employed. Without when you were employed, you cannot do it. You will always be giving your effective date of employment. Now, you will be on a salary of what? 40,000 for the first 12 months. That's the meaning. And this will increase by 2,000 in subsequent 12 months. Every subsequent 12 months, you will get 2,000. That's a normal increment. And it will be going on until you hit 60,000 cities, where you will no longer be getting any increment again. If after hitting 60 and you have not gotten to the year that you want, please don't add 2,000 again. You have to be repeating the 60, 60, 60. You'll be marking time at that time because you have reached the highest notch of your scale. So now let's go and learn how to determine the salary for 2017. Given a scale from 1st July 2012, use that one to determine how much salary will the person earn in 2017. This is how you go about it. Remember, the scale says that for the first 12 months, you'll be on a salary scale of 40,000. And this will increase by 2,000 in subsequent 12 months. And it will go on till 60,000 when it will no longer increase, and you have to repeat it if you have not gotten to the year you want. So if I want to go by that, then in writing the date, the person was employed on 1st July 2002. So the first 12 months, it will be to 30th June 2013. This is not the basis period, though. It's just the effective date, 12 months from when you were employed. They say you will be on a salary of what? 40,000. And this will increase by what? 2,000 in subsequent 12 months. So from July 2013 to June 2014, when you add 2,000 to the 40, it becomes 42. Then in the next 12 months, from July 2014 to June 2015, when you add 2,000, it becomes 44. And you will be doing this until you think you have gotten the period, the basis period that you want in the year of assessment. Remember, the year of assessment is 2017. And the basis period in 2017 is January to December. That's the basis period. These ones are not basis period. They are just dates beginning from when you were employed, how your salary will be increasing. And that's what you are going to use to determine your salary for the basis period. So you will be doing that when you get to 30th June 2017, because you cannot get up to December here, you have to add one more 12 months. And that will take you to 30th June 2017. And if you should add 2,000 to the 48, you get 50. Now from here, you cannot determine January to December now. You get January to June here. 6 months. January to June is 6 months. So you multiply this figure by 6 divided by 12. This whole figure is for 12 months. And you are looking for only January to June here. So you 6 over 12. Then the remaining July 2017 to December 2017 will be here. And that is also another 6 months. So this figure 2 will be divided by 6 divided by 12. Now when you add these two figures together, the result is a salary for the 2017 year of what? Assessment. So this is how we do the scale. Very, very interesting one, of course. Now this second illustration, Sir John, may God have mercy on his soul, was employed as the head of the legal department of Azigiwe Limited on salary scale of what? 50,000 Ghana by 4,000 Ghana to 70,000 Ghana effective 1st September 2010. Determine the salary for 2016. Oh, then you start 1st September 2010 to 31st August, the first 12 months from when you were employed. The salary will be what? 50,000. And this will increase by what? 4,000 in subsequent 12 months. So you continue writing it like that by adding 4,000, 4,000, 4,000. Now remember, 2016 year of assessment, you are looking for 1st January 2016 to 31st December 2016. Okay? So you continue writing until you get a date that you can get your basis slot from. So when I get here, I cannot end here because I only get up to 31st August 2016. So because of that, I'll add 12 months more. And that will be 1st September 2016 to 31st August 2017. Then I'll come and look for my January to December. I'll get January to August here. But remember, when I got to 31st August 2016, I hit the 70,000. Meanwhile, I didn't get the whole of the December I wanted. So I was forced to do another 12 months. But when I did that, I didn't add 4,000 to the 70 again. Why? Because it is up to 70,000. So under no circumstance should your working be more than up to. Okay? So in that case, I have to repeat the figure. So I'll get January to August, 8 months, divided by 12, I'll get this figure. Then September, October, November, December, I'll get it over here. That's also 4 months. Multiply by this, I'll get this figure. And then when you add, normally when you repeat the figure and you do the multiplication, you still come back to the same 70,000. So this is how we calculate the salary scale. Very, very interesting, of course. In some cases, it can be a percentage that, oh, Sir John was employed on a certain date, like the 1st September, on a salary of 50,000, and this will increase by 10%. Determine the salary for 2016. Oh, that one should not be a problem at all. All you all do is that you still write the same date like this and making sure you are increasing it. The first one will be for the first 12 months, but in subsequent ones, be increasing it by 10%, 10%, 10%, 10%, 10%, till you get the period you want. And then when you do your multiplications, the result will be the salary for that particular year of what? Assessment. Okay. So now this is the format of your presentation. Assuming now you want to work a question under employment income. The name of the employee, then the requirement of the question. If they say compute the chargeable income, you write computation of chargeable income for the year of assessment, then you write your basis what? Period. Then you start with your basic salary. Add all cash allowances and benefits. Examples, cost of living allowance, subsistence allowance, entertainment allowance. If the question says accountable entertainment allowance, don't add. Travel allowance, night duty allowance. So all the allowances, and then you add fees, commissions, gratuities, leave pay, overtime. This overtime will be for employees who are not qualifying junior employees. That's the one we bring here. But if the person is a qualifying junior employee, the overtime will tax separately, like we have learned. But for bonus, it should only be the excess bonus, the one beyond the 15%. That's the one you bring here. So all these are cash benefits, so you just be adding them. And then if the employee, more of the cash benefits, a retirement payment received in respect of unemployment, for example, employer contribution to tier 3, employer contribution to SNIT, you add it to the person's income. Other payments, like you had a gift by way of cash, gifts, you add another cash benefit. All these are taxable cash benefits. You just be adding, you'll be adding, okay? Okay? Then you come, some of the payments are indirect. For example, a discharge of an expense incurred by the individual. For example, the company is paying your private utility bill for you, your own house. Your private bill is what the company is paying for you. Since it's a payment in cash, please, you put it over there. You add all. Some people, they even pay your tax for you. The amount of tax that they are paying for you, add over there. They are all cash payments. Okay? Then you add all the cash benefits to arrive to the salary to get the total cash emolument. And then you add your benefits in kind. The vehicle benefit, the accommodation benefit that we learned, the loan benefit, then any non-cash benefit you add to get the accessible income. If the employee, that's accessible income from employment. If the employee is engaged in some investments or some business as well, then you can also add those business incomes separately, and then you add the investment income separately to get a total accessible income. I repeat, in some questions, apart from the employment income, the employee may be any income from trade or from some business. Please bring the gross net profit, the net profit before the tax. You add it over there. Okay, some you have to even do examination of accounts and determine the actual profit. You add it, but then don't mix it with the employment income. It should be a business income on its own. Then you put it there. And then for investment incomes like royalties, royalty is an investment income, alimony and all those things those which are not subject to a final withholding payment. But interest cannot be brought here because interest earned by an individual from resident financial institution is exempt. Okay, so that's why you cannot bring them there. So what I'm just saying is that in some questions, apart from employment income, there can be some business income and there can be some investment incomes. If they are taxable and they are not subject to a final withholding taxes, you add it by aggregating them to the employment income to determine the total accessible income before you less the tax reliefs that we have learned from it to arrive at the chargeable income. Remember, the law allows you as an employee to deduct contributions towards welfare costs as an allowable expense, and then mortgage what? Interest. Don't forget those two also, which is an allowable deduction. Okay. If there's any foreign payments, okay, you take them, you add it to get a total chargeable income, and then you add the other income like investment income and all the like I told you to get a total chargeable income, and then you use a graduated rate to tax it. Okay, if the person is a resident employee, you use graduated rate to tax the person. But if the person is a non-resident employee, from 2018, you use 25% to tax the person at a flat rate. Now, when you don't use graduated rate, if the person is a non-resident employee, use a flat rate of 25% from 2018 to tax that person. But note, when it comes to reliefs, non-residents are not entitled to social security relief. They are not entitled to life assurance. They ask for life assurance, it has been cancelled. Life assurance relief is no more for both resident and non-resident. Now it doesn't come at all. Okay, but remember, for non-residents, they are not entitled to social security relief and those other tier things. No, they don't get those kind of reliefs and social security and all that. Then if there's some taxes that the person has already paid on account, okay, because you gross the figure before adding those taxes, you come and take them out. For example, if in a question he earns some royalty which is net of tax, okay, in adding royalty here as an investment income, okay, you gross up the figure as if no tax has been paid on the royalty, because withholding tax on royalty is a payment on account if you look at the withholding tax schedule. So you gross the figure as if no tax has been paid. Then after now you have determined the tax liability, the tax that was paid on account, you come and take it out. Okay, if the person is entitled to any tax credit, you just take it out to know the tax outstanding, or whether you need to refund some money to the person, you refund it. And that's all for the format of employment income. I think on this note, I would rather, okay, let's discuss this question, then the rest we will move into our Zoom sessions. Okay, so let's do one of them. Kochi Kawawa, a Japanese, commenced employment with Osaka Railway Ghana Limited as a technical advisor on 1st August 2019. His contract of service provides as follows: salary 6,000 per month, furnished accommodation, car and fuel, watchman allowance 250 per month, garden boy allowance 150 per month, risk allowance 100 per month. His income tax returns for the year 2016 disclose the following: he is married with 4 children, all attending second cycle schools, but he is here alone. They are taken care of by the parent company in Japan. An amount equivalent to 1,005 is spent each month on them. He has 2 life policies. The first was taken several years ago in Japan. The parent company pays the premium of what? 450 per month against a capital sum of what? 4,000. The second was taken by him on his arrival in Ghana. The premium is 200 per month against a capital sum of 3,000. Osaka Railway International paid 2,000 yen, equivalent to 15,000, for the period ended December 2019, into the account of Kochi in Japan as a cost of living allowance for working out of his home base. Osaka Railway Ghana provided Kochi with air ticket, equivalent to 4,400, to enable him assume duty in Ghana. 2 months later, he was provided an additional air ticket costing 3,000 to enable him travel to Niamey for holidays. Kochi has shares in Opara Limited in Japan and received dividend worth 5,000 in 2019. This has been remitted to Ghana. While in Ghana, Kochi purchased shares in Golden Railway Limited, a company listed on the Ghana Stock Exchange. He also purchased treasury bills worth 10,000. Kochi received dividend of 5,000 net on his shares. He also earned a discount amounting to 2,600 on his treasury bills. There is no double taxation agreement between Ghana and Japan. Kochi claims he is in Ghana to assist Ghanaians and does not understand why, as a Japanese, he should pay tax in Ghana. Required: compute the tax due for the 2019 year of what? Assessment. Explain Kochi's resident status in Ghana in relation to his income tax obligation. Let me take the second one. Remember, Kochi was employed on what? 1st August 2019. We were not told when Kochi was present in Ghana. But since we were not told that, but we knew when Kochi was employed, we will take it that Kochi came to Ghana on 1st August 2019. So counting will start from that time. And Kochi is not a citizen of Ghana, he's a Japanese. Therefore, you want to look at present in Ghana for a period or periods amounting to 183 days or more. If that period is less than that, then being a Japanese, Kochi will be regarded as what? As a non-resident employee in the 2019 year of what? Assessment. Now, as a resident employee, the question is, should Kochi pay tax in Ghana? Yes. Kochi should pay tax on his employment income in Ghana. Why? Because he is exercising the employment in Ghana. And the law says that for non-resident persons, once the income is accrued in or derived from Ghana, that income is supposed to be subject to tax in Ghana. That is the meaning of explanation of what? Kochi's resident status in relation to what? His income tax obligation. And that's the explanation here. Kochi is a non-resident employee. Since he is not a citizen of Ghana, has not been present in Ghana for a period of periods amounting to what? 183 days or more in aggregate in the 2019 year of assessment. In addition, the employment income will be said to have accrued in Ghana. Thus, even though a non-resident, he is liable to pay tax in Ghana at a non-resident rate of what? 25%. And you get 4 marks for this particular explanation that you have given. So don't joke with this kind of explanation. Then the first one is the format. You give the name of the person, the computation of the tax due for the 2019 year of what? Assessment, and then what? The basis what? Period. He was employed on 1st August 2019, and in employment income is the calendar year, so it will end on 31st December 2019. He will be on a base salary of 6,000, and if you look at August to December, it's 5 months, so 6,000 times 5, you get 30,000. The format is that you have to add all consolidated cash allowances and cash benefits, and we're told all kinds of allowances: watchman allowance, garden boy allowance, risk allowance. This one is very easy. But now look at this one. This one, family upkeep. Some people may not know this one. Let me go back to the question and show you. We were told that he is married with 4 children, all attending second cycle schools, but he is here alone. So the children are not in school in Ghana. They are taken care of by the parent company in Japan. You see, we learned that when they are taking care of your children and they are spending money on them, it will be a cash benefit. Remember, the amount is being spent on them in Japan. The question is, why should we add it to the income of Kochi in Ghana? Yes, it is by virtue of his employment in Ghana. That is why his children are being taken care of in Japan. So the fact that the payment has been made in Japan doesn't mean that the income is not being earned in Ghana. No, the income is still being earned in Ghana, because the source of that income, being the employment income, is being exercised in where? Ghana. So take note of that. Rather look at the source of the income. That's the most important thing. Where it is being exercised. And the source is employment income. And it's being exercised in where? In Ghana. Therefore, any payment that is being made to Kochi as a result of his employment in Ghana, regardless of whether the payment was made in outside Ghana or in Ghana, please, you have to add it to Kochi's income and tax. Take note of that. Otherwise, some people they mess up over here. Then number 2, so he has 2 life policies. The first was taken several years ago. Remember, like I said, life assurance is no more. But let's see whether there's any payment which has been made on behalf of Kochi here. If the employer makes any payment on behalf of Kochi, which is a private payment to Kochi, not for the purpose of the employer, please, it must be added to Kochi's income and tax. The parent company pays premium of $450 per month against a capital sum of $4,000. So the premium which is being paid by the parent company is a cash benefit. So you multiply $450 per month and add it to Kochi's income and tax. Now the second was taken by him on his arrival in Ghana. The premium is this. This one is not the parent company who is paying. So there's no benefit or gain over here. So you don't add anything here and tax. Now, he is also being given a cost of living allowance. Oh, you just add it. Cost of living allowance to the cash benefit and tax. Then you are done. Osaka, Ghana provided Kochi with air ticket equivalent to what? 4,400 to enable him assume duty in Ghana. We learned that any passage to the country to assume your appointment, if you are a non-resident person, that should be exempt. So in this one, we will not go to add it to his income and tax. Okay? But 2 months later, he was provided with an additional air ticket, costing how much? 3,000 to enable him travel to Niamey for holiday. Hey, this one is for enjoyment. That one, it will be added to his income and tax. You see the question? So, look at this one. Kochi has shares in Okpara Limited, located in where? Japan, and received dividend worth of what? 5,000. If Kochi has invested in Japan and Kochi is a non-resident, any income earned outside Ghana will not be subject to tax. It doesn't matter even if the income has been remitted to him in Ghana. As a non-resident, incomes earned outside Ghana are not taxable. We learned that under the subject matter. While in Ghana, Kochi purchased shares in Golden Railway, a company listed on the Ghana Stock Exchange. But we're not told the dividend. He also purchased treasury bills worth what? 10,000. Kochi received dividend 5,000 net on his shares. Remember, dividend is set to a final withholding tax. So if the tax has already withheld, Kochi has satisfied his tax obligation regarding that dividend. Therefore, that dividend cannot be added to his income and tax under investment income. No, because dividend is subject to what? A final withholding tax. And when they say exclude from the calculation final withholding payments. Then what of the discount on the treasury bills? The discount is the same as the interest on treasury bills. Remember, Kochi is an individual, and the law says that interest earned by individuals from resident financial institutions are not taxable. Because this treasury bills was bought in Ghana here, therefore that interest earned will not be added to his income and tax under investment income. It's exempt from tax because Kochi is an individual. Here comes the end of the solution. So it's a very interesting solution as you are seeing them here. These are all the allowances, the premium paid by the parent company, the cost of living allowance, the air ticket to Niamey. When you add this to the salary, you get a total cash what? Emolument. Then you add. Now let's see the benefits in kind. They said furnished accommodation. We learned that under benefits in kind, when there is a furnished accommodation, it is 10% of the total cash emolument. So when you get this your total cash emolument here, this figure, you find 10% of it, and that is what? That will be the accommodation what? Benefit, because it's 10% of the total cash emolument. Then let's look at the vehicle benefit. In this question, we were told that he's giving car and fuel, and car and fuel we say is 10% of the total cash emolument. So its calculation will just be like the accommodation benefit. You see, its calculation will just be like accommodation benefit. But you see that the figure is 6,025. Okay, but we said that unlike accommodation benefit, there is a ceiling to vehicle benefit. So anytime you calculate and the figure is more than the ceiling, you just show the calculation and say restricted to, and vehicle with fuel is 500 per month. So 400 times 5 will be 2,500. So the figure for the vehicle benefit rather is 2,500. Because under no circumstance should the calculation be more than the ceiling. That's the point I was trying to explain to you. Now when you add the benefit in kind to the cash benefit, the result is the accessible income. Because, and if there are no reliefs, in this question, Kochi is not enjoying any relief. Why? Because he is here alone. You understand? And the children too are not attending school here. Okay? So he will not enjoy any relief. And he doesn't qualify for social security and all that. So the accessible income therefore becomes what? The chargeable income. And being a non-resident individual, it will be taxed at a flat rate of what? 25%. That's all. Okay. So I'll move from these questions. We'll discuss them in our Zoom session. Okay. We'll discuss them in our Zoom session. So, but let me do for this one also, and then I'll look at the rest of the theories on this, and then we can conclude this topic, and then do the rest of the questions in the Zoom. Okay. Now, Mr. Osebobie, so this guy, the moment you see, this is a citizen of Ghana, so he's a resident employee. So the global basis will apply. An amputee, so this one, you see disability will come in. You see amputee, was a senior accountant of Soroku Mines Company Limited, a mining company for many years, with a base salary of 54,000 per annum. He was entitled to company vehicle, fuel and what? Driver. He acted for the Director of Finance in March, April and May 2016, during which month his salary was raised to 5,000 per month. Mr. Osebobie was housed in a company lavishly furnished what? Accommodation on the what? On the mine. Remember we said farming, mining, timber, building, construction, petroleum. If the person has been accommodated at a site where the food operation is going on, the accommodation benefit will be exempt. He was also entitled to the following monthly allowances: professional allowance, hospital allowance, if you don't have a problem. Mr. Osebobie resigned from Soroku Mine Limited on 30th June. He received the following on his resignation. He was allowed to take home the company's pickup he was using, valued at what? 5,000. Cash gift from staff, 6,100. On August 2016, he took up an appointment as accounts manager of Phoenix Limited, a retailing company, on a salary of what? 72,000 per annum. His other entitlements were agreed as follows: responsibility allowance, cost of living allowance, risk allowance, overtime pay. Hey, all the figure will be added to his income and tax. Why? Because he is not a qualifying junior employee. There's no way an accounts manager can become a qualifying junior employee. A qualifying junior employee is a junior staff whose qualifying employment income should not be more than what? 1,500 per month or 80,000 cedis for the year. He's entitled to a bonus of what? 1,500 in each December. So the bonus is 1,500 for the whole year, because it's in each December, and there's only one December in the year. Now, vehicle and what? Fuel. Accommodation only, not accommodation and furnishing. Mr. Osebobie finances the following insurance policies and also contributes to the Social Security and the National Insurance Trust. Now note that from 2016, we no longer do life assurance relief. So you don't do anything with these insurance policies here, unless they say the premium is paid by the company on his behalf. Then you add it to his income and tax. Okay. Now, so it means that you get relief for SNIT. Mr. Osebobie is not married, so he is single. But he is responsible for his 3 children. So he gets what we call dependent children's relief. And that's 200 Ghana for the whole year, you are aware. Who are all attending registered senior high school. In addition, you get child education relief for 3 children. Okay, and it's 200 Ghana per child. So 200 times 3, you get 600. Mr. Bobie supports his 72-year-old grandmother, this aged dependent relief. Because when the person is 60 years and above, and he's supporting the person, he qualifies for that relief. And it's only 100 Ghana, okay, in up to 2019. And he supports his grandmother with 300 Ghana per month, notwithstanding her immense wealth. His grandmother depends entirely on him. Now required, compute the assessable income and tax payable of Mr. Osebobie for the year 2016, 17 marks. Now, in this question, you realize that in the 2016 year of assessment, Osebobie has worked at 2 places. The first place was the Soroku mines, where he worked there up to June. So, in working this question, you though the basis period will be from January to December, you further break it down. So let me project a solution so that we don't waste too much time. Now you will see that though I have given Osebobie a computation of chargeable income for 2016 year of assessment and the base for being a whole year, I've broken it down. Within that year, he first worked with Soroku mines for this period, and that's 6 months. And you were given an annual salary of 54,000. So for working for 6 months, you just make it half. Then all the other allowances, professional allowance, they say it is per month, so you multiply by 6. But this one, acting allowance. Now let's go and look at the question, how they frame it, the acting allowance at Soroku mines. He acted for the Director of Finance in March, April, and May, during which month his salary was raised to 5,000 per month. How will I know that? I have to look at his previous salary and know how much was it per month. 54,000 divided by 12. Okay? So if I do 54,000, okay, if I do 54,000 divided by 12, that's 54,000 cedis divided by 12. It's 4,500. But they said when he acted in March, April, and May, they raised his salary to 5,000, which means that he's getting an acting allowance of 500 each month. So to be able to get the acting allowance, you first find how much salary he was previously earning, and then you look at how much he is now currently earning for these 3 months. The difference will give you the acting allowance, and that is the 500 times 3, and that's 1,500. I hope that makes the explanation clearer. Then we were told that he had a cash gift. So now you add it to his cash benefit and tax. And when you add this to the salary, you get a total cash emolument. And when he was with Soroku Mines, he was given a pickup. Okay? They dashed him when he was going. Because it was a physical car, you put it under benefit in kind. But they said they valued it for 5,000. So you add it to his income and tax. Then there was a vehicle benefit. He was earning vehicle with fuel. So that a vehicle, fuel, and driver. And that one is 12.5% of the total cash what? Emolument. Okay? And when you calculate the figure will be more than 5,000. Actually, this 5,000 figure should have been shifted somewhere here and underlined. 12.5% of 40,000 will give you 5,000. This should have come somewhere here. And then you underline it. And then you restrict the answer rather to 600 per month. Because under vehicle benefit, under no circumstance should the calculation be more than what? The restricted figure. So the figure there is 5,000 plus 3,006. And that will give you 8,600 for the vehicle benefit. The benefit in kind. And then when you add, you get 48,600 for his employment income from Soroku Mines. Then you go and determine his employment income from the next company, Phoenix. Phoenix, they said he started there from August, which means July didn't work. Okay, so from August to December, his salary for the whole year was 72. August to December is 5 months, so 5 divided by 12 times 72, you get this one. Then you add all the allowances, responsibility, cost of living, risk allowance, overtime, to get a total cash emolument, then his benefits in kind. Remember the other one, I didn't bring the accommodation benefit because he was working on the mine site. But now, sometimes you can tell the examiner this. You can do this. Under the benefits in kind, you can write here, accommodation benefit, and bring dash to this place. Okay, I would prefer you do that one rather. But it means that you are telling the examiner that the accommodation benefit is what? Is exempt. Okay? Why? Because he's working with a mine and is residing at the mine site. That's why the accommodation benefit is exempt. Okay? Now, but as for the insurance company, that one, the accommodation benefit is not exempt. And it was only accommodation only, so it will be 7.5% of the total cash emolument. So this figure, you find 7.5% of it. Okay? And here too, the vehicle benefit calculation, the figure was more than the restricted. So you restrict the answer to this one, 25. 500 times 5. And then when you add it to this, okay, and you add it to the total cash emolument, you get a total employment income from Phoenix. Okay? And then when you add the two employment incomes, you get a total employment income, that's the 38,513 plus the 48,600. That is giving you 87,113. And then now you less all the reliefs. In this question, there was Social Security. He was told that he was contributing to the Social Security scheme. So as an employee, 5.5% of the total cash, of the basic salary, of the basic salary. So you put the two basic salaries together and you find 5.5% of them, then you put the figure here. Disability is 25% of the total employment income. Okay, so 25% of that will give you a disability relief. Dependent spouse, children, 200 Ghana. Or dependent children because it's one married. Child education for all the three, 200 times 3, 600. Age dependent for only one person, so 100. So when you put all the reliefs together and you subtract from the accessible income, you get a chargeable income. And then you are done with that question for 17 marks. Now, if the question should ask you to calculate the tax liability, now let's take advantage of how to do, and I think you even know how to do it, the graduated rate. They will give you the scale in the exam room, the tax scale. The tax scale will always be given to you in the what? In the exam room. Remember this question, okay, they say accessible income and then the tax payable. Okay, so they'll give you the scale. So you say the first, you just copy, first figure is there, you just copy it at a rate. So this is the chargeable income this is the rate, is free. So the chargeable income, the figure will be, the tax will be nil. Next, 1296 at 5%. So 5% of this figure will give you 6480. Next bracket, 1812 at 10%. It gives you 181.20. The next bracket is 33180 at 17.5%. Will give you this figure, which means that so far you have calculated the income of 38880, but the total chargeable income was 6130. So that will push you into the last bracket, and to determine that, you subtract how much figure, the total figure, from what the chargeable income that you have already calculated. The difference will give you the last bracket, the exceeding figure. Any figure exceeding 388, that's the difference between the figure that you want to calculate the tax on and the figures you have already calculated the tax on. The difference there is 22,420 at what? At 25%, and that will give you the tax liability. And then you add the 5% tax that you calculated on the bonus. Now, for the bonus, no portion of the bonus was more than 15%. Let's go and look at the bonus figure. Now, if you look at this question, the bonus is 1,005. So how, and remember, the bonus was given to him when he was working with where? He was working with Phoenix Limited. So you come and look at the salary, come here, salary, find 15% of this salary. Okay? Because that's the salary for that year of assessment. Okay, 15% of it. The figure will be far, far above the small bonus figure of what? 1,500. So it means that all the 1,500 will be taxed at what? 5% separately, because there is no excess what? Bonus. So that's what we are showing here, to add to payee. This is a payee. And then add the bonus at 5% tax separately, 75, to get a total tax liability. They gave 34 ticks, and it was for 0.5 each. Okay. Remember, life assurance claim is no longer applicable under the Income Tax Act of 2015 at 896. So we don't bring that one at all in the reliefs. That's all. Then, which lump sum payments are taxable and which lump sum payments are not? And what's the rationale? The lump sum payments which are taxable are annual bonuses. It's normally a lump sum payment. They are taxable, so you add it to the person's income and tax because it is from the work done. Payment in lieu of notice, the same. Payment in lieu of leave, end of service benefit, and ex gratia, they are all taxable. They are lump sum payments. Awards and incentive schemes, these are all taxable. In one past question, students were asked to explain which lump sum payments are taxable and which lump sum payments are not. So that's why I've just projected this one. Examples are annual bonuses, payment in lieu of notice, payment in lieu of leave, end of service benefit or ex gratia, they are taxable. Award and service schemes, and even commitment fees. Sometimes, if an employer wants to poach you, they can pay you a commitment fee, like the way they do to the footballers. Okay, it's also a lump sum payment. The commitment fee, you also add it. Then, which lump sum payments are not taxable? We said severance pay. The rationale is because it is painful to lose your job. And any statutory redundancy payment, because it is statutory, it will not be taxed. Transfer grant, okay? If you are an employee and they are transferring you to another branch or district, employers will normally give you a transfer grant. It's a lump sum payment. It is not normally taxable. The reason is that it is to compensate for your inconveniences. Lump sum pensions are also not taxable, and this is exempted under Section 7 of the Act. Workman compensation is also not taxable. It's a lump sum payment. This is because of the physical injury suffered, and it's also under Section 7 of the Income Tax Act of 2015 at 896. Okay, so please, this one is at 896, not at 592, at 896 rather. Okay, so I think I'll therefore pause here, and these are going to be the discussion questions which we will be doing when we meet in our Zoom lesson. Okay, now finally, what is primary and secondary employment? Okay, the IRS Act, which we are no longer using, distinguishes between primary and secondary employment. But with the Income Tax Act of 2015, they didn't lay much emphasis on that. An employee shall have only one primary employment at any one time. And where an employee has more than two or more employment, he shall nominate one as his primary employment on the tax relief application form. An employee primary employment during the year of assessment is therefore the employment with respect to which the employee has nominated on the tax relief application form. The nomination may be withdrawn only at the end of the year. If you want to change that one, you can only do that at the end of the year. On the other hand, the IRS Act defines secondary employment as that which is not primary employment. So here, what they are saying is that sometimes you will see an employee who is in more than one employment at the same time, unlike that of Osebobie. Osebobie, he resigned from one place and went and worked in another. So that is not primary and secondary. For primary, where an employee has more than one employment at the same time, for example, you are a doctor in the morning at Kolebu and you are a doctor in the evening at Smith Hospital. So when the main arm ends, you are taking salary at Smith Hospital, you are taking salary at Kolebu. So the law says that in that case, you need to nominate one as your primary employment. So the one that the employee himself has nominated, that is what is referred to as a primary employment. And you cannot change it until the year ends. And once that one has been nominated, then all other employment will become secondary. Okay. Now, the Income Tax Act did not set a distinction where an employee is engaged in an employment which is not the main employment employee, otherwise referred to as other employment consecutively in the year of assessment. The employer in the other employment is required to withhold a tax of what? 10%. So I'm talking about the treatment. The tax in the other employment, you have to withhold what? 10% from the other employment of such an employee. Such a tax withheld is, however, a final tax, but it's not a final tax, but a payment on account. In determining the chargeable income of the employee or the assessable income of the employee from all the employment sources in the year of assessment must be added to arrive at the total assessable income. So here you make sure that in taxing it, whether it is job at Kolebu, job at SNIT, please do the normal computation and put all the figures together to arrive at the total assessable income. Okay, then you slap the individual tax relief against it to arrive at what? The chargeable income, and then use the graduated rate to tax it. Okay, then that tax 10%, which has already been withheld, you deduct it to determine the net tax liability. So where an employee is engaged in more than one employment, all you need to do is to determine the total assessable income from the first employment, determine the total assessable income from the second employment as well. Do your normal tax computation using a graduated rate, okay? And then if in the secondary employment, remember they say the employer is supposed to withhold a tax of 10%. If that has been done, after you have calculated the tax liability, you only less the 10%, and that's all, and then you are done. A question of this nature came in IC in November 2018, but at that time it was the IRS tab, okay? But remember, in the Income Tax Act, you just put the two incomes together, and then you compute your tax liability on it. The normal way that we do employment income. Thank you, and we hope to see you in the next topic.